Hey guys, Dan Darrow here for Options in Play video update. Um, and I hope you guys all had a fantastic weekend. Um, Today, what I'm going to talk about is Goose. And there were a couple questions on the VTF about the calendar call spread that we did for the trade, for the earnings trade on Goose. And this video is going to talk about what we saw that attracted us to the trade, why we closed out the entire position at once, which I think was where a lot of questions arose. And, we'll try to like answer why we did and kind of the thought process behind that, which is, kind of like a general rule for a lot of like these calendar spreads. So this is a chart of the XRT here, and as Kurt talked about last week, the XRT has been absolutely on fire. As you can see, just in the last 2 weeks, you get like a monster move, and thankfully we have participated in a good portion of this, not the XRT specifically, but we have been in a bunch of stocks that have had monster moves, and a lot of times, a lot of times, like we were playing strangles, looking for volatility both ways. But for the most part, a lot of them had been working higher until Taylor Brands, which is the one Kurt just talked about, that actually got hit. But retail had been strong, and Goose was the name that we were looking at for earnings. And basically, since the end of May, which you can see right here, since the end of May, Goose had really taken off. And uh, part of the reason why it was so strong was because the retailers were kind of getting squeezed up, like the entire sector, as you saw with the XRT. The XRT was running, Goose was benefiting from that, but also more specifically, Goose was benefiting from action in peers like Burlington. So as you can see, Burlington, which reported 2 weeks ago, or a little over 2 weeks ago, had really strong results. And obviously, Burlington sells coats. I mean, they sell more than coats, but I mean, Burlington Coat Factory, they sell coats. So when they had a strong report, it was going to like bode well for a name like Goose, which specifically sells like winter coats as well. So as you can see, Burlington took off, also coincided with Goose taking off, and uh, you know, it Goose was already having like a strong run, and then just kind of exacerbated it. So a strong stock and a strong trend started to take off into earnings, and this is kind of what we consider. Let me get rid of this Burlington. This is kind of what we consider a trending stock trade, and uh, typically. When a stock has a move, just a really clean move, it could be higher. In this case, it's higher, but it could be lower. Uh, what you think is that the results are tending to get very one-sided, right? So retail was running, cold weather stocks were performing well. Goose has been just in a really clean uptrend for the last couple of months. So you would have to assume that the expectations were getting very high, right? People were expecting good numbers. The stock had like a pretty large move into earnings. So we call this a trending stock trade, and what that means is like it's typically a scenario where you see a more muted reaction, right? When things are one-sided and people are, kind of like all in like agreement that like something's going to happen, then it tends to be like more like a sell the news event. So we say muted reaction, basically as it compares to what the option makers are pricing in for earnings. Um, and additionally, I mean, you could see like Goose never really like extended too far away from moving average support. So it would have runs up a little bit past the 8 and the 20, but it would always reverse. It would always reverse. So as it kind of extended here, it just seemed like it was in a scenario where it was like set up to either have like a smaller move higher, or just even kind of like pull back to like this moving average support, which has been really key over the last couple months. Um, so when we saw that the options were pricing in 4.5, we kind of like walked back, and we saw that over like the last 3 quarters, this was like a quarterly report. Over the last 3 quarters, the average move was about 4 and 0.3 points, give or take. So, a little under 4.5. Versus this quarter, they're pricing in 4.5, which, seems reasonable. That's what it moved on average. But when you take into consideration like the move it had into this report, we were thinking, expectations are high. 4.5 is about what it moves. So like, there seemed like there was like a reasonable chance that it was going to move less than that. Um, and what we like to do in like these scenarios and these trending stocks like setups is we like to do calendar spreads, because basically what that does is it takes advantage of the near term heightened implied volatility. So for instance, like the last week's options were pricing in like a 4.5 move versus the July options were pricing in, maybe like 6. So for an extra month, so the July main month is the July 20th. So for an extra month, you're basically looking at like $1.50 for like the time value, because most of like the premium for like the 30 days is built into like this options, built into like the earnings expectations. So what we would like to do is we like to do these calendar spreads, and you're basically like, what we do normally is like we go to about like the outside band of the move. So for Goose, that would be for Goose that would have been right around 50. So the stock was trading at 45 right here the day of the report. You can see it was a little bit above 45. So we were targeting the 50 calendar call spread, basically just because it fell right outside that $4.50 band. Now, fast forward and you'll see this is the one day. This is Friday's move on Goose. You can see it had like a monster move, and you know, admittedly, like the number was great. I mean, they had a huge top line beat, revenue beat. They made a profit for the quarter, which was positive considering that they were expecting a loss. So that's always a good thing. But I mean, considering where it came from and how high the expectations were, like even like a good number, I mean, like you still like are like blown away by like the extent of this move. I mean, this is like another 30% move on top of what it was already up after Burlington, and just in the last 2 weeks, which was like right here, you can see it was already up like 15%, and then another 30% on top of that. I mean, there's about 10% short interest, so you could chalk up some of it maybe to short squeeze, but still, I mean, that's still like it ended up moving about 3 times what they were expecting, and then this is after already having like a huge run into it. So our calendar call spread, we sold to 50, bought the 50. So we sold the 50 for June, bought the 50 for July, right? Clearly the stock went way past that. $10 passed. I mean, at one point it pulled back to like 53, but by the afternoon it was back near like 58, 59, 60 area. So, by the time it opened, we were already like the stock had already sailed well past our calendar spread strike. So in a situation like this, I mean, ideally, obviously, you want Goose to close at 49.99 on Friday, right? Because then the 50 calendar call spread expires worthless. But in this scenario, it went way past. So what you can do is basically 2 things, and either you can uncover the short side, right? So you could buy back the short 50 call and have like the long July, or what we tend to do is we take off the entire thing at once. And to get into the math of this, there's really like a reason why, and it's because it changes the risk to reward dynamics of the trade like materially. So when the stock is up here at 60, right? Say we bought back that short July, the short June 50 call for $8, right? So then the net debit of the trade going in was about 95. If we bought back the short side of it for $8, then you basically add that difference to your net debit. So instead of being like 95 cents, the trade balloons to over $8, right? So if you bought it back, then all of a sudden your debit of the trade is $8. I mean, today you can see Goose is continuing higher, but if you were to if this had happened on the downside, so say like this reversed and the stock was down 3 points, then you're sitting in a July 2050 call that that, instead of being at 60 where it closed on Friday, it's down at like 57, 56, and all of a sudden like that call is worth like 6 or 7 points, but your net debit of the trade, because you bought back the short side at such like an inflated price, you're losing money. So it's like the risk to reward has materially changed. Your debit has ballooned from less than $1 to over $8, and then now it's like if it had pulled back just a little bit, then all of a sudden you're underwater. And you know, it basically what it comes down to is you know to make the reward worth it, to make the risk worth it, the reward would have to be at least 2 to 3 times. I mean that means you need like a move up into like the 70 area, which we just don't see happening, or we didn't see happening. So we took the whole thing off at once, basically flat. It was like a small loss, but it just didn't play out the way we expected. And I mean, like 9 times out of 10, you see like a stock in a trend like this, and you're thinking, okay, like it's gonna be it's going to be priced in. So I mean, a different sector, but just we can show you like Adobe. I mean, you have like a move like Adobe, and it's already like it's already had like this huge run. It has like earnings. You can see it just pulls back. So like that, they were expecting a $10-ish move on Adobe, and what happens? It has like a small move back to like the moving average support, because I mean expectations were for a great number. They had a great number, and it just pulls back. But Goose blows it out, and it changes our trade. So in those scenarios, we like to just take the whole thing off. Instead of adding all the extra debit to a trade that already isn't playing out the way we anticipated, we'd rather get out flat, wait for a new setup, and just kind of go with what it gives us, going forward, because there's always a ton of trade opportunities, and if something doesn't work out, that's fine. There'll be other opportunities, and you don't want to like put yourself into a bad position just because like something didn't play out the way you're expecting it. So I hope that answers some of your questions. Again, I'm glad for all of you guys like tuning into the videos and subscribing to the newsletter. If you're out there in the VTF and you have any questions, please don't feel free to reach out and like ask us stuff. We're always happy to like go over why I think what our logic is behind trades, what we're looking for, and really like how we manage things. So we do appreciate all the feedback, and definitely hope that this addresses some of like those questions that you guys had. So I hope you guys have a great rest of the trading day, and a great rest of the week, and we'll talk to you guys soon. Okay.